Hello, ladies and gentlemen. We are from Group 6 and we are going to present on WorldCom accounting scandal. Our group members consist of me, Muhammad Yusuf Ashlan, Joanna Kalun, Kwek Chun Han, and Chan and Chen. Without further ado, we'll proceed with our presentation.
WorldCom was a provider of long-distance phone services to businesses and residents. It started as a small company known as Long Distance Discount Service (LDDS) that grew to become a third largest telecommunications company in US due to the management of the CEO Bernie Ebbers. LDDS started in 1983. It consisted of an employee base of 85,000 workers and they are present in more than 65 countries. The plan was designed by the WorldCom CEO Bernard Ebbers, followed by other senior executives who committed 11 billion in WorldCom financial system. So in 2002, the U.S. Securities and the Exchange Commission's SEX filed a lawsuit against WorldCom. For this case, there are a lot of ethical issues like unethical work culture, which is pressuring the employees to manipulate the accounts, and the employees who play along with this case will be rewarded, and if the employee don't want to follow for this one will be threatened. So the action of false accounts was mislead the various of the stakeholders. So for the next slide, we can show that the key players involved in WorldCom scandal. Bernard Ebbers is the CEO in the company. Scott Sullivan is a CFO and the secretary of the WorldCom. David Melius is the controller and the senior vice president of the WorldCom, and Cynthia Cooper is a CIA of the WorldCom, is a chief internal auditor, and Buffett Buddy Yates is a former director of the accounting at WorldCom. Betty Vincent, former director of corporate accounting at WorldCom. Arthur Anderson LLP is the Kenneth M. Avery and the Melvin Dick were the primary auditors presenting their firm in the WorldCom scandal. So the main responsible for this case is the board of directors and no consecutive directors, and also the internal audit team.
How did they do it in terms of the fraudulent activities? They have fraudulently took billions of dollars in operating expenses and spread them out across the property accounts, which is a type of capital expense account, and the property account does not even exist. This allows them to show the expenses in smaller amounts over a span of years, instead of reporting them immediately to the investor. In 2001, the company inflated revenue estimated $3 billion and reported 1.4 billion profit instead of a loss. If the operating costs had been reported correctly, WorldCom would have suffered a loss for the year 2001 and the first quarter of 2002. Why did they do it? In terms of business strategy, WorldCom had acquired 11 companies in only 6 years, and they have failed to properly integrate them in the organization. This is because merger and acquisition are costly, time-consuming, and lead to managerial challenges. For financial, Ebbers wanted to protect and maintain his personal financial condition, so he had pledged his own WorldCom stock to secure his personal loans and finance his personal business. This is to ensure that the stock price of the company will not go down. For expectation, Wall Street has expected double-digit growth for WorldCom, and Abus had no intention to inform Wall Street that WorldCom need time for the consolidation and digestion of the acquisition. Pressure from the top management. This is because organization top management has participated in fraudulent activities on regular basis. Therefore, from emails record, certain employees in terms of part of the operating were well aware of the accounting irregularities and participated in hiding such practices. The auditors as well has failed to identify the accounting irregularities and didn't persist to try to identify them. Another thing, the corporate culture had poor values, ethics, and promoted fraudulent conducts. We will now look at the factor contributing to the fraud when undetectable. The first and foremost, corporate culture. The top management's action and beliefs followed by the employees. The employees followed what they have been told to do, including fraudulent activities. The auditor. The auditor did not expect that the chief financial officer, or anyone for that matter, at the second largest telecommunication company in the world to make such simple accounting fraud. Corporate governance. The employees did not communicate on the fraud because they have been worried about losing their job. Airbus also has a very high control despite lacking of the experience. Internal control. The absence of the proper check and balances and segregation of duties made it easier for the fraudulent act to be done. And last but not least, the intention. Arthur Andersen complied with professional and Securities and Exchange Commission standard. However, he has claimed that WorldCom tried to alter and omitted information to mislead Andersen.
What we have learned from WorldCom in the moral of the story to board of director and auditor. The duty of the board was to correct the weakness of the company that management was unable to see. In the WorldCom scandal, the close relationship between board member and CEO undermines their responsibility to be independent of the company and its management. Board of directors of companies should be responsible for overseeing management and inspect its plans, performance, and activity. The director should also approve the company's strategy, review its financial statement, and evaluate security policy. For an internal auditor was to focus more on improving the organization operation. The auditor must try to reduce or eliminate risks that could create losses and improve the efficiency of operation. Internal audit aims to report independently and directly to the audit committee to avoid the influence of top management. The external auditor was the one responsible for providing investor and creditor with independent advice on company financial situation. The auditor should spend more time on conducting analytical reviews and testing control. So next, what could have been done to prevent the fraud? Reducing the dictatorial power of the CEO. The board of directors should ensure that the CEO has no right to arbitrarily dismiss any employee who attempts to report fraudulent activity. It will also allow the board of directors to independently access the company financial information, thereby avoiding abuse of power. Randomization of internal and external audit. To perform audit more often, take a larger audit sample, and more involvement of the board of directors may help prevent or detect the action that occur in the company. Routinely audit areas involving cash, refund, product return, inventory management, and accounting function. In addition, occasional unscheduled audit can also help detect high-risk fraudulent activity in key business areas. So last one, establish reporting system. It should establish a reporting system that enables employees, supplier, and customer to report any suspicious fraudulent activity. This is to provide an opportunity to blow the whistle without fear when they discover any major financial violation within the company.
Response to fraud. We can see the first one is the removal of top management, is what WorldCom has did immediately. Those who had involved in the scandal like Ebers, Sullivan, and Myers has left the company. The second one is the replacement of new board of directors with recruiting new president, COO, CFO, general counsel, and director of internal control to guarantee no more previous relations and create the independence about the management decision. The next one is to shut down the finance and accounting department in Clinton, Mississippi. This is where the fraudulent activities occurred. Any cause and factor that a fraud had occurred also has to be removed. And there are more than 400 new finance and accounting personnel were hired. And a new independent auditor was brought to re-audit the financial statement for the fraudulent period. Those assets that are overstated were evaluated for impairment, and the goodwill from the previous acquisitions was written down. And the use of stock option was also abolished and restricted, with full expensing value of equity grants was implemented. A thorough review was initiated to strengthen the company's internal controls, and a new ethics program can be implemented. And lastly, training programs is crucial to provide to the employees and educate them on the manner of their responsibility at the company, and especially focusing on the accounting issues. This may signal an irregularity. In consequences, the first consequences is towards the company, which influence the company trust. The trust in the market, in industries, and in accounting firms are all eroded. A $750 million settlement is to compensate investors. The stock price fell below $1 per share, and this company faced bankruptcy in 2004 with about $5.7 billion in debts. For stakeholders, the first one is around 30,000 people lost their job. Those who have committed fraud activities has also been sentenced for jail. CEO Ebers, 25-year prison sentence for him, and 5-year prison sentence for CFO Scott Sullivan, and 1-year prison sentence for Myers, with $642.3 million of retirement funds were held in stocks. And lastly, creditors is unable to collect the debt, and the shareholder value lost as $180 billion. In telecommunication market dropped 7% in year 2002, and the share price of Nokia, Sony Ericsson, and Vodafone has declined. Thank you.
Ladies and gentlemen, with that, we end our presentation. We hope that you enjoyed our presentation and gained a little bit of information that you can apply in your future endeavor. With that, ladies and gentlemen, thank you and have a good day.